with. I certainly did. If you get it right away, you're better than I. So let's dig into it. Put option. We strike a deal for someone to buy or insure the house for $200,000 a year. Anything happens to the house, they will, what we call a put option, kind of like home insurance, is they will put it back. So if I have my garage that burns down, all right, for whatever reason, all right, the home insurance contract is, and my house becomes, worth less, the home insurance says we will put it back. If the roof flies off, they will put it back. That's what a put option will do, or a home insurance contract will do. Well, let's use an analogy here. Let's say you have a neighbor, and the neighbor doesn't like you very much, all right, and for whatever reason. And let's say you're going on vacation. Let's say you're going to skiing, maybe to Utah, or maybe you're going to ski to Vail, Colorado, one of my favorite places to ski, or maybe July 4th. I don't care. Maybe you're going to Mardi Gras. Wherever you go, let's just say it's, let's say you're going skiing, okay? You're going to Vail, beautiful, beautiful resort, Vail, Colorado, okay? You go there, and your neighbor says, you know what, I really don't like you. Every time you take out your garbage, gosh, I'm disgusted about you. And in fact, anytime you go to work, I would wish, maybe I get ambitious, and I'm going to burn your house down. Oh my gosh, that's not a very friendly neighbor, right? Well, you say, all right, well, listen, I've got home insurance, not worry about it. So you go, you take your vacation to Vail, Colorado, you do your skiing, you hit your double black diamonds, and you come home, and there was a fire at your house, okay? Your neighbor set fire to your house. And in this circumstance, that's not a very friendly neighbor, right? Maybe you'd consider moving, or maybe being a little nicer, maybe slowing down in the subdivision. I don't know, whatever you want to do here. But if the house burns down any time before the year expires, our loss is covered up to $200,000, okay? Well, we pay $2,000 premium for the policy. We do not get this money back even if the house burns down. Everybody stay with me on this, okay? If you pay a premium for insurance, they never refund your premium. They don't do that. They'll pay on the policy. They don't refund your premium. Humorously, I went into one of my good friends. His name is Bruce in Crystal Lake, Illinois. He's a fantastic State Farm agent. He's been with me for years and years and years. And I watched his beard go from dark to white and his golf score go lower and lower and lower. And he's doing very well for himself. And I went into him one time and said, Bruce, I've been paying money to you for all these years and I've never used your insurance. All right? I want you to pay me all my money back. And he laughed. He said, come on back, let's go to lunch, something like that. You don't get your money back, do you, if you don't lose the policy, right? That's what's called an option. You don't get it back. So in this circumstance, we have a $2,000 premium and a very expensive graphic here, if you'll notice there. That's your house is burning, okay? The house goes down in value to $150,000. And you have a contract that says that State Farm or whatever great insurance company, they will put it back. So that policy that you bought for $2,000 actually becomes worth $50,000 to you, right? That house catches fire, there's $50,000 in damage. Our policy covers the $50,000 loss. So that little contract that you have becomes now worth $50,000, okay? It's kind of unique. The only way you make money on insurance is when something bad happens. I think that's a bit unique, but I guess that's the way it is. Now, you need some insurance. You can be overinsured, but you need insurance on the key things in your life, right? So let's go to a put option example. ABC is currently trading at $34 per share, all right? Everybody, here we go. $34 per share. Okay, got it. $34 per share. You think it'll drop in value over the next few months. Why? Why would you think it would drop in value over the next few months? You take everything from our buy signals and you flip it upside down. Okay? So you notice we have a 30-day moving average moving down. We have the stock below the 30-day moving average. The stock rises up to the 30-day moving average, hits it on low volume, fresh red on MACD. The stochastics are just starting to tip over there a little bit. We're noticing we have some red arrows, and the stock's in a downtrend. We take a look at the industry group. We notice the industry group is now starting to keel down a little bit. We click over to the big chart. We notice that institutions are starting to pull their money out. Well, that's a pretty key indicator that a rising tide lifts all ships. Consequently, when the tide lowers, the ships are going to go down. If the institutions are pulling their money, it's going to go down. Great candidate for a put option, all right? I know this sounds a bit unique. I'm all about, buy American and, we like things are going up. But that's not reality. In great times, we can make money when things go down. Is it possible for us to make money when things go down? Did people make money when, let's say, Enron and WorldCom went down? Yes or no? Oh, my word, absolutely they made money, okay? Again, different skill set, maybe a little bit different education, okay? So you buy an option contract that gives you the right to sell 100 shares of ABC for $35 per share. Hold on. The stock's at 34, and you're buying the right to sell somebody else the stock at 35. You're going to actually buy the right to put them the stock at 35. That's what a put option is. To sell them the stock at $35 a share. The contract expires in 3 months. All right? So that is 3 months worth of time. Instead of you having the right, a call is the right to buy, a put is the right to sell. So instead of having the right to buy something, you now have the right to sell something. A yin and a yang, okay? All right? Here we go. You pay $2 per share or $200 for the contract. What's the most you could lose? $200. So far, so good. There are now 3 things you can do with your option. You can sell it, exercise it, or let it expire. So again, let's go over this. The stock is at 34. Let me go over here. The stock's at $34 a share. You are bearish on the stock. You buy an option contract that gives you the right to sell the stock at $35 per share. Now that said, the contract expires in 3 months. You pay $2 a share for the contract. There are 3 things you can do. Now let's find out what we can do. The $35 put. If in fact that you're wrong, and the stock actually goes up, you'll lose money. If you're right, you have the right to sell somebody else the stock at $35. In this case, it goes down to $30 a share. You sell your option for $5. Now hold on one second here. Let's do the house example. The house is $200,000. I have the right to put it to my insurance company for $200,000. It then becomes worth $150,000. And I've got the right to put it to them at $200,000. That means my contract's worth something. The stock's at $34 a share, and I'm right. It actually catches fire. It becomes worth less. I have the right to put it to somebody else at $35. What's 35 minus 30? That's $5 a share. Now my put option is worth $5 per share. That's about it, okay? Again, took me a while to understand it, but that's the concept. Now, before I move on here, this is a bit unique. You do not actually have to own the stock in order to buy a put on it, all right? So for example, if I have a home insurance contract on this gentleman's house, this house, and this house, a home insurance contract, for whatever reason, and all 3 of these houses start on fire, and I have a home insurance contract, does anybody know what that's called? That's called arson, first of all, okay? But if I were to have a home insurance contract, and all these, I don't have to even own the stock, or I don't even have to own the house, excuse me. See, I'm using that interchangeably. And they burn, I get paid. So if I look at a stock, and folks, and just now borrow from your past. Borrow from year 2001 and 2002. Could you have found stocks that are going down? One student, I remember, raised their hand. Yeah, any stock with a vowel, it was going down, okay? So I'm like, okay. So we can find this in bearish environments. And now the blinders are coming off saying, I'm open to the fact that I can make money now in a bearish environment because I'm betting that it's going to go down. All right? Again, new way of thinking a little bit. But let's take a look. Is it possible for you to be wrong? And instead of the stock going down, it trades flat? Well, absolutely. You have the right to put somebody else the stock at 35, and the stock stays flat at 34. You bought your option for $2, and now it's only worth $1. And if you remember, we sell all of our options at a 50% loss fairly non-emotionally. We don't warm fuzzies about it like the guy's taking money from your register. We're gone, okay? So we lose 50%, we're gone. We were wrong. That's the way it is, okay? And if you're really wrong, you thought the whole thing would go down, and you're wrong, it goes up. Is that possible? It's possible. And take a look. In that circumstance, it goes to $37. The option will expire worthless. Why would that option expire worthless? Let me think. The stock's at 34. I'm betting it's going to go down. I'm betting that I'll have the right to put it to somebody else at 35. Now, it then becomes worth 37. If I have the right for somebody else to sell the stock at 35 and it's worth 37, it's going to become worthless. Think about this. If I have a home insurance contract on a home worth $200,000, and then the home becomes worth $250,000. It's going to become worthless. I need to go ahead and follow the trend, like the option is concerned, and make sure I'm betting that it's going to go down. The trend is your friend. So the right to sell, okay? So everybody run with me on this one. Here we go. A call is the right to buy, and a put is the right to what? Sell. That's it. You've got it, okay? So that's the right to sell, put option, at a set price. That's what's called the strike price. On or before a set date. The expiration date, you pay money for this, it's called a premium. It's also a premium or the cost of an option. The cost of insurance or the premium on insurance, the same thing. Cost and premium, same thing. Or the option quote. The quote, the premium, the cost. I've just said synonymous words, okay? They all mean the same thing. Now, basic elements of an option. It controls 100 shares. We've kind of gone over that already. Expiration date, that's the third Friday of the month, whether it's the third Friday of January, February, March, whatever it may be. Strike price, that is the exercise price. That is the price that we have chosen to do the deal, all right? Premium, that's the cost, the quote, the cost, whatever it may be. Buying a call option review. We're going to review each of these. Let's go. You're forecasting that the stock is going to increase. Why? Because you're a student of our system, okay? We're not going to review that. We're going to kind of expect you to know the stock information by now, okay? You're a graduate of that course. Let's move on to the next. You're going to expect to know how to find good stocks and how to know your buy rules and your sell rules. We'll review them a little bit today. We kind of expect you to know that by the time you've reached our option class. Each call option represents 100 shares. You pick a strike price, you pick an expiration month, and you pay a premium. That's it. That's it. All right? Now, buying a put option. Let me go back and forth here. Look at this. If you look at the slide, everybody focus on the slide. Buying a call option review, you're forecasting a stock increase. Now, just focus on the first bullet point. You're forecasting a stock increase. Now, watch the slide. Boom. Buying a put option, you're forecasting a stock drop. Everything else is the same, okay? Everything else is the same. All right? Buying a put option, you're forecasting the stock will drop. Now, let me give you some key definitions. These are maybe a little bit confusing at first, but here's key definitions. Number one, at the money, an option with a strike price that is equal to the actual stock price. In the money, the option actually has value if it is exercised at the strike price. And out of the money option has no value if it's exercised at the strike price. An easy way to remember out of the money options is that if you trade them, you will soon be out of money, okay? It's an easy way to remember them. So let's follow with me on this visual. Let's say it's a call option, okay? Let's go back to calls. I know they kind of did that put foray there. It's a little bit harder to understand, but we'll get it. All right, let's say the stock's at, I don't know, let's say $32 a share, okay? $32 a share. If the stock's at $32 a share, the at the money option would be the closest. The options are either 35, 30, 25, every $5, so 25, 30, 35, 40. Well, from 32 down to 30, that's only $2, so that would be called the at the money. It's the closest to the current stock price. Anything that's above is called out of the money. So your 35, 40, 45, 50, those are out of the money options, all right? And then anything below 32, like the 30, the 25, the 22.50, et cetera, those are called in the money, okay? In the money, the closest is the at the money, and then anything that's above the current strike price in a call option, those would be out of the money, okay? Out of the money, at the money, and in the money, all right? Just terminologies. We'll be using them the rest of the day. Your coaches will also be using them. Warning, if you ever see two contracts with the same strike price, but different symbols and prices, stick with the contract that has the normal option root symbol and the highest open interest. If you're not sure, always call your broker before you place a trade. Most of these contracts are odd contracts created as a result of corporate action and usually have an odd number of shares. So friends, this is kind of what it would look like. Big fish swallows little fish, all right? And anybody who owns little fish, you get 0.6725 shares of big fish company. Well, if you own options on little fish, then you have 0.672, options on Big Fish Corporation. Now that said, if you notice an odd, figure there, be careful of that. Call your broker up. By the way, call your broker. Don't call me. Don't call, your coach. Your broker is the litmus test. We will coach you. We'll work with you. But your broker, he or she is the one that they give you the profit loss happens there. Your education happens here. So call your broker. They're the final word, right? So call your broker up and say, hey, listen, I've got, and you'll notice it kind of will stand out. I've got these symbols, these, let's say ABC, FJ, ABC, FK. All right, those look, and then I've got, XXZ, FK. Well, it just totally stands out. I mean, it doesn't even look the same. And the bid on my normal options are one's $1, one's $1.50, one's $1.75. And then these ones with a unique symbol, it's $15. Or it's maybe super cheap. Oh, it's 20 cents. Everything else is $1.50, and this is 20 cents. And some of you will think, well, I'm getting a bargain, okay? All right, no, that's not the case. Is many times, instead of controlling 100 shares, it only controls 37 shares. That's why it's only 20 cents, okay? So it's not correct. We don't spend a whole lot of time on that on the workshop because it happens less than 5% of the time. And let's say big fish swallows little fish, that's going to be over. Those options are going to expire, and then it's no longer the case. So after Cisco buys that small company, or after GE does a merger, or whatever it happens, it goes from there. This also can be very profitable if you'll ever notice companies that are move in and out of indexes. This is a little bit more higher level stuff, but if you'll notice a company is being bought, there is what's called a queue, or there's a line of stocks that are ready to go into an index. So let's say, for example, we've got 500 stocks in the S&P 500, and all of a sudden there's a deal. All right, we buy you, you buy me, or we do a deal together, and one of those stocks literally gets eaten up or does a merger, and they're in the Standard & Poor's 500. Now there's a space in the Standard & Poor's 500, okay? Well, there's a queue of stocks that are ready to go in. All right, so the next stocks in queue, they're ready to jump in, and we've actually been very, very profitable playing options on that. Why? Because mutual funds, their job is to mirror or outperform the Standard & Poor's 500. That means oftentimes they'll buy the stocks in the Standard & Poor's 500, and if we've got the new guy on the block and we don't own them, we want to mirror that behavior, we're going to go ahead and pick up some of that stock. So options on those stocks can be very, very profitable. It's more of a trading little trick that we used to use, and we still do. Not a whole lot of buys and sells are happening on the Standard & Poor's right now, but that's a little bit of a warning. Now, let's go over the rules to live by. Number one, only invest money that you can afford to lose. Only invest money you can afford to lose. Now, friends, if you email me and come to me and say, hey, Michael, I have got to make money on this trade, and I'm confused. I'm losing money right now. Help me understand it. Where we went wrong is in the first sentence. I've got to make money. That's where we went wrong. If you are trading with your car payment, your grocery money, or your mortgage, is it possible for you to become emotional? Yes or no? Amen. Yes, absolutely. You will become emotional, yeah. So we don't trade with, the mortgage money, all right? We trade with money that is earmarked for risk capital, all right? The trend is your friend. I'll be saying that all day here today. The trend absolutely is your friend. We need to buy stocks in uptrends. We need to buy calls on stocks in uptrends. We buy puts in downtrends. Now, most of you folks that are taking this will be learning about buying stocks and calls. And soon, the market will head down, yes? I mean, it's gone up 25% in 2003, and we're very bullish in 2004 and 2000. We don't know. But if, in fact, not if, when, in fact, we get Alan Greenspan tightening up the screws, slowing down the economy a little bit, it's going to happen, all right? When he does that, and some of these stocks start tipping over a little bit, you'll be very delighted that you now have the knowledge to make money in flat environments and make money when things head down, okay? The trend is your friend. Time is your enemy. When you buy time, time is your enemy, all right? When you buy time, time is your enemy. When you sell time, time is your friend, all right? When you sell time, time is your friend. If you're wrong, get out. Let me rephrase that a different way, all right? Everybody, focus here. If you're wrong, get out, okay? Make sure that's focused, okay? That's about it. If you're wrong, get out. Remember asset allocation, all right? Asset allocation simply says as many stocks trade in sympathy with one another. I used an example before, that the airline industry. The airline industry, we had bad news in the airline industry. Business travelers were not traveling. They're, just, doing things on the internet and video conferencing, and nobody was traveling. And, United, American, Delta, they're all doing kind of bad. Well, then sure enough, Southwest Airlines, which was making money, they tanked down too, all right? So just remember asset allocation. I would not invest all my money in any one industry. Now that said, again, you don't need to be the jack of all trades. Get to know a few different industries very, very well. I have a few industries that you'll be hearing from me in the workshop, or you email me, or you subscribe to a newsletter that I work with, and you'll know what I'm trading, all right? And that said is when Alan Greenspan does something, or when the Michigan consumer sentiment comes out, or when housing starts come out, or whatever economic indicator comes out, I know how my stock and my industry group will react to that because I'm spread out. I'm understanding different asset classes. Invest the same amount in each play. If you have $10,000 in your account, we don't put $9,000 in one trade because we're very excited about it, and we only put $1,000 in the trade that we don't think will go well. Well, first of all, don't put $1,000 in something that you don't think will go well, and you don't put 90% of your money in another trade. An easy way to do this is to use the same amount in each trade. So for example, $2,000 a trade or maybe $1,000 a trade. That said, if you're watching these DVDs, all right, and if you're at home or whatever you're at, your job initially is not to become a millionaire by Thursday or Friday of this week, okay? That's not your job. Your job is to learn how to trade, okay? The markets will be around. Your skill set needs to rise. You need to learn these tools. Your job is to learn how to trade. If your coach says, hey, you know what I'd recommend? Maybe you pick up this book. Or I recommend maybe you do this or follow. You know what I'm saying? If they recommend that stuff, you know what? I want you to get up early, stay up late, and learn it. Because the Boy Scout motto is be prepared. Opportunities will come this year. They'll go to the people who are prepared. Does that just make logical sense? Yes or no? All right, good. Invest the same amount in each play. Focus on a few strategies. Friends, there's 7 strategies we're going to talk about today. 7. I don't trade all 7. I use them every now and again. I focus on a few that I really, really like. So don't be the jack of all trades, master of none. Don't overtrade. That is a common problem. I've had that problem, all right? I've had where I go to the market, and it's been a week's worth of time that I've even been involved in day trading, all right? There's circumstances that the market is very favorable. It's fairly easy to pull, $500, $1,000, maybe $2,000 a day out of the market. That's kind of fun sometimes, right? And you can get addicted to that. It's almost like a drug. There's books on it, on how to treat it. It's like an addiction almost, okay? Now that said, please be very, very careful. That's why you should have a trading journal and maybe even a trading partner that you say, hey, listen, I've lost $10,000 this week, but I think it's going to come back. No, you need to reconnoiter. We need to take in your horns, your bullish horns, and you need to relax a little bit, okay? Be careful of that overtrading and use stops to avoid large losses. Absolutely 30 to 50% on an option. All right? Now, what I've gone over here, let me summarize. What I've gone over here today is the kind of a review. Let me review. I've gone over a little bit of what is a call and what is a put. We understand that controls 100 shares. We understand that they have strike prices, expiration months, things like that. And however, now what I'm going to move to is how do we use this, all right? How we use these calls and puts, what environment do we use them in, and how do we use those to profit, all right? So we'll be back shortly to learn more about that.